Good afternoon, folks, and welcome to Real Vision Daily Briefing. I'm Andreas Larsen, joining you from Copenhagen, Denmark. You can see it's getting dark out here, so it's late evening here in the northern parts of Europe. We've had a massive amount of market action to unpack you for today, and I'm super happy to be joined by Tom Thornton, the founder of the hedge fund Telemetry today. Welcome, Tom.
Hey, nice to see you. Yeah, we have a lot to unpack. Quite a day. I want to talk to you and ask you questions about the ECB meeting today. That was something else. And something about interest rates happen in Europe. What else? Equity markets in the US closed flat, dead on the lows here today. Nasty last 2 hours. Woof.
Yeah.
Ahead of the CPI.
I mean, it's been quite an action-packed day. We had, of course, the European Central Bank out earlier this morning, European time, and they basically reignited the front end of the euro rates curve with some communication around interest rate hikes coming up over the summer. It was quite the mess of a press release, if you ask me. And as you mentioned, Tom, equity markets disliked this move that we've seen in interest rate markets. What do you make of the moves that we've seen in the U.S. equity space over the past 24 hours? Yeah.
Well, we've had this really choppy week, and I think the market has been dragged around and whipped around with option dealers that have, I think it's $3.2 trillion of options expiring a week from Friday, tomorrow. And the gamma levels are 4,100 and 4,200. So once we broke the 4,100, that's where I think the dealers had to sell more to protect themselves and increase the deltas on the downside. So that's kind of the thought I have there. And I do believe that it's just a lot of concerns about the CPI, and everyone has their crystal ball out trying to figure out what is going to happen tomorrow. And we'll talk about that. That's what I'm told, right?
Yeah, for sure. I mean, we will, of course, also give our opinion on what's going to happen tomorrow with the CPI report. But before we get to that, Tom, I know you watch at least parts of the European Central Bank's press conference as well. What do you make of what they told markets seen from the other side of the pond?
It just seemed to me that she was trying to satisfy everyone involved, the hawks, the doves, everybody. In the 25 basis point direction for July, I think that was an attempt to satisfy the doves. I mean, the first comments I was getting, oh, this is a dovish ECB, but I think that there was talk that in September, 50 basis points, so that would satisfy the hawks. I just think that you can't, in the central bank world these days, be weak. And as you said, it was one of the worst comments. Why don't you tell us why?
I mean, when I read the press release earlier today, it kind of struck me how many what-if scenarios they included in one press release. I don't think I've seen as many what-if scenarios included in one press release before. So it was kind of a mess to get through it. And they started very firmly in this press release by basically stating that there is one mission and one mission only now, and that is to bring inflation back to 2%, which is quite needed. I mean, if you look at the inflation pressure over the past 3 months in Europe and annualize it, we are basically running at above 16% now. Crazy numbers, right? And then you're absolutely right that it felt like they had to compromise between hawks and doves, which is something that we've seen before from the European Central Bank. We know that the part of Europe that I live in tends to be more hawkish, and then you have the Southern European members leaning more dovish due to the massive debt load of their countries, right? So essentially, it ended up as some kind of compromise with a very weak message In terms of July, only 25 basis points. I think markets basically looked for more, or at least looked for a risk of more than 25 basis points. And then they only opened the door for 50 basis points in September if they have to adjust inflation forecasts even higher again. So it is really tricky to figure out what they actually mean. And it is, by the end of the day, a European Central Bank, as we know it, they will take it meeting by meeting. The forward guidance is very weak. So that leaves it very tricky to trade, I think. So I guess that's also something that you've been saying recently, Tom, that it's tricky to trade markets these days.
Yeah, it's tough. And, sometimes you can have all the data and everything, and the market will just turn on a dime, up or down. And I've been saying all year on Real Vision, on the daily briefing, on my notes, that we are going to have a lot of bear market bounces. We might have just seen the end of the last bounce, which I think we got about 12% out of the NASDAQ and 10%, maybe a little bit more on the S&P. But things change really, really fast. And I think you just have to be very nimble, adjust your exposures very quickly. I have actually a lot of cash, like a 30% cash weighting going into the CPI tomorrow, because I'm not sure where it's going to come out. I'm on the side of it's going to be the whispers around 8.5%. I know that you were saying that it could be a little lower. Now I've heard that there could be a seasonal adjustment, but I think that just looking at the gasoline prices in the last month and this month already to start, I think we're going to see, I don't think we're at peak inflation yet. It may start to level off at a high level, but we'll probably have another couple months of this, especially going into the seasonal travel mode for vacations. And you have the natural gas issue that's another thing. But why don't you tell me why you think we can come in a little lighter on that, or under on the CPI?
I think there's a distinction between core inflation and headline inflation when it comes to this debate. If we look at core inflation, that number will, in my view, come in on the light side, basically due to base effects. So we are measuring the core inflation against a very rapid increase in a couple of categories at this exact time last year, not least when it comes to the price of used cars and trucks. So that makes me bet on a surprise on the low side for the core inflation. But I agree with you on the overall inflation number, because if you look at the development in gasoline prices, it seems as if to me that markets haven't penciled in completely what we've seen at the pump over the past 30 days, because it's been a massive move and something that's even on the radar of Joe Biden right now. I think he will be watching the screen tomorrow.
He already knows what it is. He was on Jimmy Kimmel, a talk show last night, and all he was talking about was inflation. And look, back in January, he had a press conference, and the first thing he said was the Fed has to control inflation. And this is right after the Fed Chairman Powell was renominated. And so that was the most important thing. I believe the most important thing for the Fed right now is to control inflation. I don't think they care about the stock market wiggling around. I think they would be fine if the market went down. That would help financial conditions, lower financial conditions, and having the interest rates move higher should, at some point, crimp demand. And I'm watching the housing market here in Connecticut and New York. My daughter is trying to buy a house, her first house, and I'm like, you can't buy a house right now. And she's got a baby and her husband, and her husband doesn't want to buy it. But I'm seeing price drops. I'm seeing substantial price drops on houses, and I believe that is starting to trickle into the housing market. So I'm more concerned about inflation staying around, and look, if it drops down to 7%, it's still high. Yeah. It's still going to hurt companies. And think about all the companies that rely on fuel, on other commodities. It's it's going to be around for a while. And I pulled my Bloomberg chat room, and basically everybody is in the belief that 2 months, we'll probably have 2 more months of high inflation before we start to see maybe some moderate drop. And let's just say, on the other hand, what do you think will happen with the markets if we come in sub 8%?
Well, first of all, I think you're absolutely right at pointing to the price pressures that producers see, right? If you look at the PPI, not the CPI, then we are running at double digits inflation everywhere around the globe. So the cost pressure is clearly there for companies. And therefore, I also lean the same way as you do when it comes to risk assets. I think we have another leg lower coming up. But if we get a surprise on the low side on core inflation, it may, of course, sugarcoat a bit of the upside surprise that I expect in energy prices. But right now, all that matters to me is energy prices, because that's basically the focal point for the politicians. I made a somewhat stupid chart showing Biden's approval ratings compared to the price of gasoline at the pump, and they're one-to-one correlated since New Year's. So for Biden, this is the most important political point. So I think that's what matters to the Fed as well. Don't you think so as well, Tom?
Oh, absolutely. And we're moving into a very political period with the midterm elections with Congress. And I think that the Republicans, if they can not fall into the trap of a few different policies and Supreme Court issues, they will sweep these elections only because of the inflation issue. And that's all anybody cares about in the US. And I'm sure it's the same way in Europe. I just think that they have no plan, no idea what to do. They're relying on the Fed. And look, tomorrow, one of the things that I think a lot of people are going to hear is 75 basis points. I think people are going to start talking 75 basis points for the Fed next week. I think that the odds, as you can see on Bloomberg, will probably start to rise with a higher CPI. I think that even if it's in line, I wouldn't be shocked to see them do 75. It wouldn't be the worst thing to just push a little harder, because I think you and I can agree, the central banks are way late and they overstimulated, and now they're trapped in, this is what we got.
Yeah, to me, it makes a ton of sense to try and front load the tightening now. And that is essentially also the direction the Fed is moving in. I'm a bit more uncertain on the European Central Bank because of all of the structural issues that they have. But for the Federal Reserve, I sincerely tend to agree. And therefore, maybe even a print at 8.5. I think that's the consensus. If you look at the screens right now, would be enough to prompt speculation of a very hawkish Fed next week. But let's assume that the market is starting to move in that direction, pricing the Fed even more aggressively than what we've already seen. Would that be a trigger for a new leg lower in equities? What would you sort of gauge to make that assessment?
You know, oftentimes the bad news gets priced in before the event, and I wouldn't be shocked that we see some sort of bounce potential after the Fed. It's at this point, it seems like it's a very low probability, but if we continue going lower into that Fed meeting, I could see maybe a relief rally coming out of it. But I think that we're really in a very, very difficult spot right now. People are really starting to feel the inflation. You see it on the news every single night, and it's just pounding on people right now. And I'm a little older than you, and I saw inflation as a young kid when I lived in California growing up, where it got to a point with gasoline that they were rationing gasoline, and you had to, like, you could buy gas on odd or even days based off of the last number on your license plate. Now, we're not there yet, but people are posting on their phones and Instagram and Twitter, how much it costs to fill up their car. and that's just going to grind on people's sentiment and the market. I think it's just a bad period right now.
Yeah.
Boy, I'm happy, right? I mean, Mr. Happy today.
I mean, personally, I've been humbled almost by the inflation pressures that we've seen this spring. I've never ever seen anything like it in my life. Born in 1989, I've never seen inflation at these levels. So obviously, this is something completely new for me to deal with from a professional perspective, and it has surprised me how sticky it's been. So this is clearly something that you also need to take into consideration as an asset manager, as a retail trader, whatever you are. This will have an impact on markets over the next 6, 12, 18 months still.
Yeah, it's going to last a while. And the thing that's why it's going to last a while is the Fed is aggressively doing what they can to hurt demand, the demand destruction. But here's the other problem. There's a supply chain issue here, and there's a demand imbalance, especially in the energy markets. You also have a war happening not so far from your country. That's putting huge amounts of pressure. Now, let's play what if the Ukraine-Russia, there's a ceasefire, that will be a relief. But it's not going to be like everything's going to be back to normal immediately. It's going to take time, but there'll be a relief bounce, and which I certainly hope there's an end to that stupid conflict.
Yeah. And a bit of anecdotal evidence from my side related to that conflict in Ukraine. I recently bought a car in Denmark, and no matter which car manufacturer I visited, they all told me that they had part of the supply chain parked in Ukraine. So it's essentially impossible to get a car in Europe right now due to the conflict unfolding in Ukraine. So it is a bit of a mess, and the reason why prices are increasing to a large extent. I wanted to briefly play a clip for you in relation to this, because if inflation is lasting and if it's more sticky than anticipated by many, then it might also be the trigger for a regime shift when it comes to equity styles. And Simon Mikhailovich, the co-founder of Bullion Reserve, had a remark in this regards on another show at Daily Vision, Real Vision, sorry. So let's have a look at the clip.
Investors will look for probably non-financial ways of investing money into businesses, into tangible assets, into tangible proven stores of value outside the financial system, probably, if financial system were to experience the kind of disruption that I believe is highly likely, not guaranteed, but highly likely. And it's, in a sense, it's a return to back to basics, Graham Dodd, value investing, looking at realistic balance sheets, realistic, sustainable balance sheets, sustainable earning streams from products that are not subsidized by debt. And that's where I think they will look for it. But I think it's very situational in terms of what types of securities would make sense and in terms of what types of assets. So I think that given the financialization of the last, say, 30 years, I think it's going to be a very big shock and a very big change in sentiment.
Interesting remarks from Simon here when it comes to companies with a very solid earnings and income stream, because essentially he's saying that this will become important in the new era. And in that regards, Tom, I know that you've been posting some updates on Twitter related to tech stocks. And I guess some people will claim that some of the tech stocks, they don't have solid income streams in an environment like this. Can you please take us a bit through your thinking on the tech sector in the current inflationary environment and how you would gauge what's going on in that sector?
Right. Well, my view on tech is that, and when we get these bottoms and tradable bottoms, I've been advising to buy into the higher quality, more recognizable companies. They're going to have an easier way of moving higher. You have a lot of people that have tried to buy some of the really beat down, garbagey type names, and they worked on the first and second bounce that we've had so far. But this last bounce, it was really, you didn't really see the moves that we had on the other. So we're losing the lack of resolve or the conviction that people have with some of the more lesser quality names. Like I bought Microsoft, I had some Apple, and I'm still long Adobe. I was long AMD, and smart, NVIDIA worked out. And now I think I just have just a few right now. I'm long some Electronic Arts because I believe that there is an M&A transaction ahead for them. I'm still long Adobe. I think it's a very sticky business, great management. Products are, you just can't do without them. But I recently took some off. I've been able to trade this market. I make mistakes. I sometimes sell a little early, and let's see some profits, go, past me. I recently bought into some of the China internet names. I bought Alibaba before earnings, and it popped. And it's been these false starts with the China internet, and I've been on the side of these are uninvestable when the government is at war with these companies. But they're starting to soften it up a bit, and they had a nice move this week. They gave some back today. But I keep my exposures at a very defined size. My personal trading is defined by 5% is my max size position for anything. And I'll start in a bear market type chop buying a 2% weighting. And as much as that doesn't seem like it's exciting, you can still make money, and you can widen your stops because you're not as anxiety driven with a huge position. That's just it just works for me, and it's made me money this year.
So you still see opportunities here and there in the tech sector, despite inflation rising, despite interest rates going up, making it difficult to buy the sector on the more structural level, right?
Yeah, I'm a little concerned about some of the semiconductor names. Intel gave guidance at a conference this week, and it was just awful. And this is in technology. There's the cockroach theory that you can't just have one cockroach and there's no others. You open up the cabinet and boom, there they all are. And that was in 2000 how the tech wreck started. You started to see a couple companies give guidance cuts, and I think Intel is good enough for me that they're seeing slowdown in PCs and other verticals of where they supply chips. And customers might be, at this point, we might have another glut of semis out there. So that's kind of what I'm watching right now. And semis to me are really the part of the food chain, the tech food chain that I watch the most.
I also noticed that you made a short remark related to the holdings of Spotify within the ARKK ETF. Could you please elaborate what that was
Right.
about and why you're watching that?
Well, we've talked about on Real Vision a bunch of times ARK and Cathie Wood and her. I watch her trading style day to day. I have a site that I watch, and I see what she's doing. And one of the names that I bought and I sold it recently, it was Spotify when it was under 100, and it's down from 400, or I believe it's around 400. So it's been down pretty significant. The CEO bought $1 million or a boatload. I forget the amount that he bought on an open market purchase. That to me gives a little bit of confidence that he sees his company bottoming. But the thing is, every single day for the last month, I see ARK funds selling substantial amounts of Spotify. And that was one of the reasons why I bailed out of it, because I just want to wait for her to finish. And now I looked at a chart today that someone sent me, and her holdings have gone straight down, and the stock has been fairly steady. And if we clean her up and that she's out of the picture as far as a seller, I think the stock could lift. I mean, it's now getting a little late in this bounce, obviously, that it may not, but we really want to see a big seller like that exit.
Yeah, it's a very interesting point, Tom. We have a great question from Travis asking about the relationship between interest rates, bond markets, and equities, because he noted that we didn't get a reaction in bonds when we had this late sell-off in equities today. And you and I quickly debated before we went on air whether the next leg lower in equities could actually lead to a rally in bonds. What do you make of this relationship and the road we have ahead?
Well, we've had, look, in bad bear markets, you can go back to 2011 in Europe. Rates spiked. This was in the Greek, tragedy of the Eurozone, summer of 2011. Rates spiked, stocks went down, and so you had just no place to hide in Europe. And that's been happening here in the U.S. And in Europe, so to speak, with rates moving higher, and that relationship and stocks, going down. That relationship where the risk off, you buy bonds, and that just hasn't. That's not. That doesn't apply in this market. There will be bond bounces, and sentiment in the bond market is absolutely dreary, and market sentiment for me is a condition. It's not necessarily a trigger. And I always get these things where AAII sentiment polls, oh, it's really low, the bearishness, blah blah blah. It can stay bearish for a while, and you want to look for triggers. And I'm starting to get some DeMark signals in the bond market, and I will be honest that this has been such a strong trend with rates that the signals have only seen very nominal reactions, a stall, a couple, days of rates going down, and then boom, they go right back up. And that tells me a lot about how strong this the bond market sell-off is. So I'm not buying bonds here. I've been more bear in bonds. So it's but I can see a bounce possibly developing here, and maybe it'll be tomorrow. I don't know.
Yeah, I mean, it's been one big mess to be a bond bull this spring. I tried to dip my toes into that market once, just before Putin invaded Ukraine. That was an absolutely awful timing, and I mean, I still lack the confidence to try and dip my toes into that market again right now. I agree with you that if you look at the positioning, the sentiment, etc., it looks like the perfect contrarian setup to buy bonds. But we still need some more evidence that inflation is actually headed in the right direction back towards 2 before we can really provide a compelling buy signal for bonds, in my humble opinion.
One thing to remember is the market is missing one of the larger buyers of bonds. The Fed is now it's QT, baby. They're no longer in the market, and that was, they were a part of demand, and now there's a lot of supply. And the further up we move in interest rates, those people that are long bonds are going to panic even more and look for liquidity. And one thing in these types of markets, they will sell everything. You can't necessarily, I'm going to hide in gold or crypto or NFTs. I mean, that's being funny there. Or you have to, and even real estate could be fading. Cash is the only place to be when bond markets unravel like this, because people look for liquidity. Oh, gold's liquid, I'll sell some gold. That's what's happening right now. And if the rate of change on rates starts to pick up even more, and that happened today, obviously, in Europe, that gets real scary for bond managers.
Yeah, it does. In relation to what you mentioned on real estate, maybe even fading now, we have a question on the YouTube channel relating to the so-called NLI, a 13 to 15% dividend paying defensive REIT, so real estate investment trust. This also relates a bit to the clip we showed with Simon Mikhailovich, a very strong cash flow generating defensive business. Would that be something that you would be willing to look at this juncture of the business cycle and what you see?
That's a 35% yield. Is that what? Oh, I don't know what that is, but I would say that I'll pass on that because most likely it's too good to be true. And we've seen a few things in this world recently that are too good to be true. And I'll pass on high yield things for more stability. Absolutely. In these markets, chasing yield is an absolute killer because, oh, they cut their dividend and boom, everything goes down. But right now, I think it's just you buy the best quality. And if the equity market goes down even lower, the first thing I do is tell people, upgrade the quality of your portfolio right there.
Look for stable cash flows. Final thing I wanted to touch upon with you today, Tom, is China. I know it's very tricky to figure out what's actually going on over there at the moment, but we have a question from Gregory asking us whether we think China is softening up or not. We had news out early this morning that parts of Shanghai will be back in lockdown as a consequence of a new spike in case counts. What do you make of the Chinese situation? Is it something you find important when you take decisions these days?
Well, of course, I think that, I saw the things were getting, locked down again in certain places. Overall, though, I think it's starting to open up, and I think that's a positive right now. I think that the Chinese government is starting to wake up and see some of the damage that they've done with the technology sector. And partly as well, they have to perhaps support some of their real estate sector because that's been an absolute disaster. And that starts to implode notably. China's got a much bigger problem than we know. And so I think right now, yeah, I'm watching China really closely. One thing they didn't do in COVID is they didn't overstimulate. And so they have bullets to, stimulate the markets, and they're starting to do a little here and there. But if things really get out of control, I think that they'll do their thing. Not necessarily I agree with a lot of things that they do, but it is what it is, and you have to follow it.
It's an absolute fair point on China being still able to stimulate markets in sharp contrast to what we see from the Fed and the European Central Bank, because they're basically forced in the other direction compared to the People's Bank of China. We don't have a big inflation pressure in China. That's basically the only place on the globe where you don't have that.
Yeah,
which makes...
in North Korea too.
Yeah.
Look, if you make up the numbers, it's pretty easy to never have that problem. But I'm just kidding there.
Fair enough. I mean, final remark from my side on China. I run a GDP model on China based on things that actually happen. So electricity production, ships leaving ports, etc. And it looks absolutely awful right now. It looks as bad as it did in February, March 2020. So to me, a lot of the hit to the Chinese economy has already been taken because, of course, if you lock down a country, you'll get a recession. That's as simple as that, basically. So I think most of the hit to the Chinese economy has already been taken. So
will there be? What about supply chains?
Yeah, that's the big issue here. They may export the supply chain issues to us, and they may export the weakening growth or the recessionary trends to us as well, both in Europe and in the US with the time lag. So that's clearly one of the things I'm watching over the next 2 quarters, whether we get the spillover effects from China. Yeah.
Boy, aren't we just full of happiness and joy today with
Yeah.
going over the markets.
Let's conclude with a final question that we received, because Ralph is asking who's on the picture behind me here. And I actually received a message last week on the daily briefing from a listener saying that it looked like Joe Biden eating a cigarette. So I don't know whether it's Joe Biden. I don't think it is, but that's my best take.
Kind of looks like Hunter Thompson. The
Could be.
Yeah, maybe. He liked to smoke and he was kind of crazy, and
Yeah.
good time
I-
probably to hang out with.
I'll ensure you to have the answer ready for tomorrow, because I will be back again tomorrow with a real Vision Daily Briefing. It's been a pleasure to host you, Tom. Thanks for being here.
Thank you, and nice to finally meet. And this was a very lovely conversation. And thanks everyone for hanging out.
I enjoyed it as well. Thanks for the question, guys. I'll be back tomorrow with Peter Boucquart, so stay tuned for that. I know it will be an interesting day with the CPI report upcoming.